Good evening. Thank you for joining us. My name is Sheena Pasco, and I'm the Director of Marketing for the Startup Path. Welcome to our free monthly webinar. Tonight's topic is financial forecasting. We will be focusing on the income statement and how to forecast profit and loss. Before I introduce our guest speaker, I would like to tell you about the resources we have created for you at the Startup Path. Step 1 features our free webinars, where you will learn the basics of starting your own business. This is also where the webinar archive is located. You can revisit or rewatch any webinar you've missed. Step 2 provides you with assessment tools to help you find the right fit between who you are and the wide variety of businesses that exist. Finding that right fit is crucial to your success. Step 3 enables you to learn a business from a mentor. We currently have 27 mentors in a wide range of industries online who share their advice and who reveal their secrets to success. We have packaged each mentor's journey and advice into a talk show format that we call the Startup Experience. Steps 4 through 6 contain 21 online lessons that cover everything you need to know about starting, growing, and running your own business. The featured speaker in today's webinar is our own resident expert in entrepreneurship, Dr. Tom Duening. Dr. Duening is the director of the Center for Entrepreneurship at the University of Colorado in Colorado Springs. He has been an entrepreneur since 1984, has started and ran several businesses, has written 12 books on business and entrepreneurship, and has consulted in a wide range of industries. Please be aware you may see the waiting room screen come up as I transition into Tom's presentation. Tonight, we will be discussing the income statement and how to forecast profit and loss. And here's Tom Duening.
Thank you, Sheena. It's great to be here. Welcome, everybody. A few weeks ago, we chatted about the sales forecast. Tonight, we're going to dig into the income statement, which is also referred to by some as the profit and loss statement. It's important to know that the top line of the income statement is your bottom line of your sales forecast. So these various statements that we're going to be discussing are highly interrelated, interlinked. And of course, that's why we use Excel or some other type of spreadsheet software so that we can run all types of different scenarios. For example, in the sales forecast, you estimated the volume of sales, your ramp rate, and also your pricing. And any of those can be adjusted now because when you start throwing costs at this, you begin to realize whether or not you've got a business model that in fact can make a profit. And you don't want to adjust your numbers so much without any kind of rationale or tether to reality. So you have to be very cautious. I mean, when we went through the sales forecast, if you remember, if you were with us for that webinar, we pushed you very hard to make sure that you were very realistic about the numbers that you were choosing. So if your income statement subsequently shows that in fact your business model simply can't work because there's too many costs associated with generating revenue, it's not just a simple matter of going back and changing your pricing or changing your volume numbers because you've already convinced yourself that you did a good job on those in the first place. So you have to be very careful about this because you could really talk yourself into a very, very bad business if you just went back and changed your pricing, assuming that, boy, if I just raise the price $1 a unit, then I can make a profit. But guess what? It's not about your price. Because I mean, it's not about what kinds of pricing you think is appropriate. It's the pricing that your market thinks is appropriate. So let's just go ahead and take a little look at the income statement. So the income statement is the only one of the statements that we're looking at. There's 4 documents. There's the sales forecast, the income statement, the cash flow statement, and the balance sheet. And the income statement is the only one that's governed by GAAP, which is the generally accepted accounting principles. And all of the rules of GAAP apply to your income statement. And that means that there's things such as the revenue recognition rule. And revenue recognition rule simply means that in the cycle of the selling process, there's a certain point in time at which the rules will allow you to book the revenue on your income statement. Whether or not you've collected any cash is irrelevant here. What matters is the rule. So, for example, if you're selling on credit and you make a transaction at the time of the signing and at the time of the credit card transaction, for example, the GAAP will allow you as a business to recognize the revenue at that point in time. But on the other hand, you haven't collected any cash yet, so your business can show revenue, but it's certainly not equivalent of cash. Just remember that. There's a lot of businesses where revenue and cash are pretty much equivalent, but most businesses are not. Most businesses do allow customers to pay on credit for a variety of things. I can't think of many businesses that are cash only. There are some that are primarily cash. For example, if we go into a Cold Stone Creamery or something like that and you're buying items generally that are less than $10, it's often the case that you're going to pay for that with cash. And in that sense, then revenue and cash are equivalent. But a lot of people, anything over $10, $20, are going to pull out the credit card today. And that means that somehow the business has got to collect that money at a different time than when the transaction was made. So, the rules tell you when to allocate your revenue, and they also tell you when to allocate your costs. And so the reason that the income statement exists is not so much for the entrepreneur, but more or less for those who are evaluating the business, because they want to know what it costs to generate certain revenues. And that's why accounting rules have sort of been changing and adjusting over time to try to make that apparent in the profit and loss statement or the income statement. So that way, if I look at your business, I can look at your income statement and I can tell how much it costs you to generate certain amounts of revenue. And then I can also sort of begin to estimate how much it will cost to get to higher levels of revenue over time. So this is a very important document for external parties to look at so they can really get a good evaluation of the operating model of your company. From the entrepreneur's perspective or from a manager's perspective, actually running the company, you can get a good idea of what your major cost factors are. So we call those cost drivers, for example, in business, and you can take a look at what are the items in your income statement that seem to be really driving your costs. And it may be that this is the part of your business where you need to spend more attention because your costs are in that particular category way out of line with the industry averages or something like that, and you're eating your profits because you're spending too much money maybe on labor, maybe you're spending too much money on rent, maybe you're spending too much money on travel and entertainment or some other cost category. So the income statement can be very good as a managerial tool, but from an external perspective, it's mostly used to understand the operating model of your company. And so there's things like depreciation that will appear on your income statement, right? And depreciation is purely an accounting principle, and basically what it means is if you own some type of a capital equipment or something, that capital equipment is worth the value that you paid for it when you first bought it, but over time that gets depreciated according to a schedule that has been set up by the accountants, and they will be able to help you figure out what that depreciation schedule is. It's a non-cash expense, which is great to have. So you want to have very accelerated depreciation schedules for your capital equipment because that will be expensed prior to your taxes being calculated. And so therefore, if you have stuff that you can depreciate with your business, no matter what size business you have, it's in your interest to talk to your accountant to make sure that you're doing that, because those are expenses, non-cash expenses, that occur prior to the calculation of your tax burden. And then of course, the cash flow statement would be much different than that. So here's just some things that we're going to be talking about. So the first section of your income statement will be your revenue, and that's entirely based on your sales forecast. And then the next section is variable costs, or what we call the cost of goods sold. So there are certain costs that are attributed to any venture that are variable. That means the costs vary directly with the number of units that you're selling. And so if you're selling more units, you got to buy more raw material, right? So that's a variable cost. It varies directly with the number of units that you're actually selling. And then after you subtract the cost of goods sold from your revenue, you're left with your gross profit. And the gross profit is just a raw number, and it doesn't really allow you to make comparisons with other companies in your industry because they may be much larger. And so comparing just the gross profit number to a much bigger company doesn't give you a good indication of whether or not your cost of goods sold and the amount that you're paying for your raw materials is in line with industry averages. So we calculate what's called the gross margin, which is simply the gross profit divided by the revenue, and that gives you a nice ratio. And your ratio then can be compared to any size company in your industry, so you get a good sense then of whether or not your model that you have for obtaining raw materials, your supply chain, and so on, is in line with industry averages. After the gross margin and gross profit line, then we have all the general and administrative expenses, or G&A, or oftentimes referred to as overhead. And these are your fixed costs, right? And these are all the things that don't vary. So it might be like your rent. Your rent is not going to vary month to month. The salary is not going to vary month to month. Expenses that you might have for professional services are not going to vary month to month. And so we'll be figuring that out in a moment. I'll show you how that works. And then your pre-tax profit, or EBITDA, that's earnings before interest, taxes, and depreciation and amortization. EBIT is just earnings before interest and taxes. And that's used then to calculate your tax burden with your business. If you have a pass-through taxation entity, which you should remember from earlier discussions that we've had regarding the various legal structures, there are some that are called pass-through entities, and that pre-tax profit then just passes through directly to you and is taxed at your personal income tax rate. If you have a C corporation, however, here's where you pay the corporate income tax, and then whatever's left after taxes is your net income. You're sometimes it's referred to as the bottom line, and you've heard that expression probably with respect to business in the past. So the income statement, each of your expenses is referred to as a line item, and you can go line by line to look at your various cost items that you want to keep track of on a monthly basis. You really need to be careful to list each of the possible expenses that are associated with your business. When you go and reveal your business plan and your financial forecast to your potential investors or your banker, they're going to be looking at, are you being thorough? Did you do a good job of understanding your own business? And so you need to generate both gross margin and net margins, which is your bottom line. That's your net income over your overall revenue, and find out whether or not it matches up with the industry. So, for example, the Risk Management Association that I've listed here and the website listed there has key ratios for most industries listed on their website. So you can go ahead and you can get a good sense of whether or not your operating model that you have for your business is in line with the industry averages. And it's a good thing to do. It's a good thing to keep track of, both for internal purposes and external purposes alike. So next, I'm going to turn to the income statement, and this is an example of one right here. I'll try to increase the size of that just a little bit. Perhaps it'll be a little bit easier to see. And so what we have here, of course, is the total revenue line at the very top. And this should match up with the sales forecast that we have done before, and I think I still have that over here. So as you can see, this line right here translates directly into the top line of your income statement. So that's your revenue, right? And what we're doing in this model is I'm assuming that this is a pure cash business. If this was going to be a credit-based business, then there would be a little bit of lag between the sales that I was putting into the sales forecast and the revenue recognition that I was able to do on the income statement. There would be a lag time based upon whatever kinds of accounting rules would apply to the type of business I have and when I could actually recognize that revenue. So in this case, just for simplicity purposes, I'm just assuming that this is an all-cash business, and the cash is coming in exactly as the sales forecast has indicated. So that's my revenue. Now here's my cost of goods, right? These are my variable costs, right, on these two lines right here. And I'm saying my variable costs include my raw materials, which is this line right here, and my shipping. And what I've done with raw materials, and this is very common in setting up these types of statements, is to just use a simple ratio or some type of a principle that would apply to the revenue. So what I've said in terms of my raw materials, I've indicated that my raw materials are 40% or 0.4 times my revenue. So every one of these is just going to be 0.4 times this revenue number. That's how much my raw materials cost me, 40% of my sale price, okay? So that just then extends across the entire line. Every one of these has the same formula built in, 0.4 times the revenue number above it, okay? So that generates then for me a pretty good indication of what the raw material costs are going to be to generate that level of revenue, okay? Then I also have shipping costs, and again, this is the same thing, and I said here that my shipping costs are 15% of my revenue, okay? So I've now spent, right, 40 plus 15 is 55% of my revenue is being used up for my variable costs. And of course that leaves my net margin then of 45%, or the gross margin of 45% and the gross profit of that number right there. And this number right here is this number minus these two together, which is this line right here. 500 minus 275 equals 225. But this is really, the gross margin number is the most relevant because this is the one I can use to compare my company to others in the industry. Okay? So then we have our G&A, our general and administrative or overhead expenses, and these are our fixed costs. So as you can see, I've estimated that the CEO's salary for this imaginary business that we have here, in fact, is going to be $3,500 per month. Okay? And then I have a total line over here, because I want to know what are the cost drivers, and I have a percentage of my total costs over here. So what this number is just this is the percent that the CEO's salary is of all of the fixed expenses together. Okay, so I've assumed a sales salary as well, and I'm going to pay my salesperson $2,000 a month. And then there's this line right here, which is called the burden. And the burden the way I describe this is just all the extra things that are added to salary that you need to pay as a business owner. So workers' compensation claims, workers' compensation insurance, you need to pay benefits, for example, to your employees, and any other things that are built in, FICA and all that kind of stuff that's built into your responsibilities or burden as an employer. And that is simply a function of your total salaries, okay? So a typical number to use there is about 19%. So what I've done is I've added up these two salary lines right here and multiplied it by 19% to get that number, and I've done the same thing across the entire line item right here. And then we might have an allocation of rent, and in this case all of the rent for the operation is allocated to the overhead. And I'm renting my space for $2,500 a month. I've got travel expenses, and I'm estimating that my travel, which is my primary technique of selling, is $2,500 per month. And I'm estimating my insurance costs to be $400 per month. Notice how these generally are not changing much in here. You see that? And I have telephone expenses, I have office supplies, office equipment, postage, and courier. So this is a company that's primarily generates its sales through direct selling, right? So the CEO and the salesperson are going out and selling. I don't have any marketing costs in here, and it may be that my marketing costs I would put into the COGS if I was going to be spending a lot of money, say, on advertising or getting on TV or infomercials or something, and then I might have a direct relationship between the number of units sold and the amount of money that I'm spending on the marketing, and so that might be actually a variable cost rather than a fixed cost. If I'm going to be paying for like brochures or something on a regular basis, I might build that into the G&A because I'm going to be spending, let's say, $200 a month on brochures and other types of items that we leave behind when we make a sales call. So as you can see, it's good to have sort of these total lines over here in this column because that gives me a pretty good idea. I can see right now that 39, almost 40% of my cost to run this business are going to be associated with salary. And if you are growing this company and you're trying to think of ways to economize, it may be that you try to find some way to reduce headcount because that clearly is one of the major drivers of your cost, and travel as well. If you add travel on there, right, with two people traveling, it's almost about 60% of my total cost. So this gives you a good example of, whether your business model needs to be modified to some extent in order for you to be able to make this work. And of course, this column over here enables you to really get a good sense of what is driving the overall expenses of your business. Plus, you can use this because this is a ratio as well to compare. This number here is just simply this one divided by that one. And that gives you the percentage. So it's a ratio. You can compare your salaries, your CEO salary, your total salaries, your burden costs, and so on to industry averages. So what I've done on this line down here is just added all the costs per month and then added up my total costs over here, right? And so when you take your gross profit, right, minus your G&A, well, then you're going to be left with your earnings before interest, taxes, depreciation, and amortization. And in this case, the brackets around the number that is in the box that is highlighting the number indicates that that's a negative. So if my gross profit is $225 and I've spent $13,595 to get that, guess what? I have a loss in this particular month of $13,370. And as you can see, that goes on for me for quite some time in this business model. I do not get out of the loss column until month 8, where I finally have been able to generate a profit. And that's not that unusual for businesses that are starting up, that you know, we have all these sales expenses and salaries and so on, so we're probably going to operate for a while at a loss. And of course, it's very important for you to have some capital in the bank, whether it's your own savings or capital that you've been able to raise, in order to last through this period of time in which you are not making any profit. Now notice that a business can be unprofitable. You know, even here the net income indicates that we aren't profitable, but you can't be without cash. So profit, remember, is purely an accounting term, just like revenue is purely an accounting term. You have to have cash. You cannot operate a business without cash, even though you can be unprofitable. And that's a very important point to remember. So eventually, here in month 8, I finally have profit, and that means I have to start paying taxes as well. Now, your accountant will tell you that there's some rules in accounting that allow you to offset some of these taxes as well. It's called tax loss carry forward, and that means I can carry forward the losses from all these months and apply them to these months. So a good accountant will help save you a lot of money, and it's quite possible that a business such as this won't have to pay any taxes for the entire year, depending on how much of a loss you've incurred during your first period when you weren't making any money. But anyway, let's just assume that we're paying taxes, and as you can see, I'm assuming the corporate tax rate of 30% is applied to this number right here, and that means I paid $2,842 in corporate taxes, and this is my bottom line, or net income is finally in the positive. I've made $6,000. When I carry that through to the end of the year, the total year operating net income for this company is $32,871. Now, you have to recognize what net income really is. Net income is the money that you have left over as the owner of the business to do several things with. You can reinvest that money back into the company and use it to grow the company, or you can pay it out as dividends and distribution to your owners. And whether, you know, if you have an LLC, which is a limited liability company, and a pass-through entity, those dividends pass through to the owners and are just taxed at their personal income tax rate. It just profits from the company. If you pass it through as a C corporation and pay dividends, well, then that money's already been taxed once, and it will be double taxed because a dividend distribution to your owners will be taxed at the personal income tax rate. So as you can see now, what we've got is a one year income statement that you can take a look, that you can observe here. Oops, sorry. That you can observe here. And the typical business plan that you would present, say, to a banker to try to get an SBA loan or something would have to be projected out for 3 years or 36 months. So obviously you have to think much harder. You have to run your sales forecast out 36 months, because your sales forecast is always going to drive the bottom line, will always drive the top line of your revenue statement. And so for our purposes here, we're just introducing you to these various statements, giving you some basic idea of how to produce them. But clearly, if you are going to be using this for actual business purposes, whether it's to sort of project, you know, whether or not this is a decent business for you to try to start, or whether you're going to go out and try to raise some capital, you're going to have to estimate your, you're going to have to forecast out about 3 years. Now, as I mentioned before, it's very important for you to look at these categories over here, because these have to match up with how your business works. I've just got these dummy categories in here for this template. But if you have additional categories that should be added, certainly by all means add another row in here and add that cost item, whatever it might be. A lot of times my students will simply use the items that I put in in there, and it doesn't really match up with their business. So, and you can eliminate these. So if you're not going to be traveling as part of your business, get rid of that. You don't need that line in there. And it's okay as well for some of these categories to start out perhaps as zero, right, for many months. And that's okay, you know, because look, we're not ordering office supplies. We ordered a whole bunch before we started, and now we're operating, and maybe by about month 4 or so, we got to start replenishing our supply. And it's also possible to vary these. So if you only buy supplies every 4 months, right, well then make it every 4 months you buy supplies. So the income statement has to kind of indicate how it is that you're actually going to be spending your money and allocating your costs over the life cycle, operating cycle of your business. I'm trying to think of what else I need to tell you about this. So get these categories right. I'm not going to worry about depreciation. Your accountant will help you understand. I don't know what the rules are about it, so depending upon your the various capital assets that you have in your company, the depreciation schedules will be different. For example, real estate oftentimes has depreciation schedules that last as long as 30 years, and that means that you have an equal depreciation amount every month for 30 years pertaining to that particular capital asset that is titled to your business. So what we've now learned is that we can do a sales forecast and we can do an income statement. And the most important statement for an entrepreneur happens to be the cash flow statement. And quite possibly the balance sheet is just right behind that. So the cash flow statement will actually demonstrate how cash flows into and out of your business. And it will also help you understand how much cash you need to raise in order to start your business effectively and successfully. So we are not going to be going into that as part of the webinar series. That stuff is all available to you in our courses on financial forecasting that we have at the Startup Path. I can't give you everything for free. I'm giving you as much as I possibly can to get you started. But clearly, if you want to do your own cash flow forecast and balance sheet, and you've been studying along with this series, I urge you to go to the Startup Path and enroll in the financial forecasting courses that are available to you, and that Sheena is going to explain more about in a few minutes. I'm going to turn this back over to Sheena now. Certainly, if anybody has any questions, would like to contact the Startup Path directly, please don't hesitate to do so. I'm now going to turn it back to Sheena. Thanks, everybody, for coming tonight and for listening to me. Thank you very much.
Thank you, Dr. Duening. There was a lot of good information in this short webinar, but as Tom did suggest, there are many additional details to financial forecasting that we just didn't have time to cover tonight. Fortunately, we do have that lesson. It is on step 4 of the Startup Path. I have it highlighted with the 2 arrows here for financial forecasting. I suggest you register for step 4 to learn more about the forecasting and also to get those invaluable templates that Tom was showing you. In fact, just for joining the webinar today, we're offering you a 25% discount to step 4 or any other item that you wish to purchase on the Startup Path. At the top of your screen, you'll see a coupon code in red. Write that down. Use it when you check out. There will be a little box at the bottom of your screen that says discount codes. You just put it in there and you can get your 25% off. We do offer 100% money back guarantee if you're not satisfied with anything. We look forward to helping you reach your dreams through owning your own business. Please stay in touch. We are here to help. Visit us at our website. You can also connect with us on Facebook, Twitter, and LinkedIn. If you have any questions or concerns, feel free to contact us at any point. Thank you for joining us and have a great rest of the evening.